Hi, everyone. Welcome to the Yes Investment Club. This is the third chapter of the basic investing course. And this chapter will focus on the stock participants, instruments, and regulators. So, when you are a novice investor, you should be able to understand the length and width of the stock market. And this chapter exactly does that by telling you about the movers, shakers, and influencers of the financial market to give you a broader understanding of how investing and trading works. So in this chapter, we'll cover four different aspects. First one is the types of participants. Second is we'll cover the types of financial instruments. Third will be the functions and objectives of stock market regulators. And fourth will be a case study on the Harshad Mehta scam. So moving on to the participants. So this segment will cover what are the types of participants and what actually is a participant in the stock market. So the definition of a stock market participant is the people who actively take part in the stock market by buying, selling, or regulating stocks. So there are different types of stock market participants. So first can be like investors, second can be traders, third can be stock market brokers. They're the professional traders who buy and sell shares on behalf of a client or an investment advisor. Then there is the stock exchanges who regulate the market. Then the financial intermediaries, which are the entities which facilitate a financial transaction between the two parties. And the last one is the regulators, which are the institutions who ensure that the market runs efficiently. So now that we have got a brief overview of how the different types of participants look like, these are more detailed ones wherein when you start trading in the stock market and start investing, you need to learn these terms. So first is the domestic retail participants. So these are the Indian residents who are taking part in the stock market trading as investors and are often likely to invest in smaller amounts. Um, then there is the NRI, which stands for the non-residential Indians. So these are the individuals who are obviously staying abroad but are still able to purchase and trade in Indian stock markets, and these also contribute to the demand and supply concept of why the stock market prices change. Third is the domestic institutions, which are also called as DII. So these are companies within India who invest in Indian securities and other financial assets based in the country, and they invest in large quantities. So the examples of these can be like insurance companies, banks, and mutual funds, etc. And then there is the asset management companies, which are called as AMCs, and these help manage funds for both individuals and companies, and can sometimes take investment decisions for their clients to grow their portfolio. So one common example can be like HDFC mutual fund, or else it can be SBI mutual fund. So these are asset management companies. And the last one is the foreign institutional investors, which are FII. So these are foreign-based funds and companies that are able to trade in the stock market and shares. And these actually boost our stock market significantly, because if hedge funds, foreign trusts, and investment companies enter into India and invest in the equity market, it's actually growing the value of the equity market, right? So these are the different types of stock market participants.
All right, so let's move on to stock market instruments. Just before we begin, just to clarify, please do not confuse these with musical instruments. These are simply financial tools that investors use in order to trade in stock markets and other exchanges. So what are stock market instruments? So as the name suggests, they are tools that can be transferred, held, or given a different definite value. So this could be anything from the shares that we covered in chapter 2 to even things such as government bonds, which we will cover in this chapter. These tools are specifically traded in the financial market for investment or trading purposes only. And so these are the two main functions that all of these instruments hold, and they serve no other purpose outside of that. So the first are the stocks. We already covered them in the previous chapter, but we can go into a little bit more detail. So when you refer to one stock, it's usually referred to as a percentage of ownership in a company one stock may represent 0.01% of a company or 1% of a company, as an example. So it's the most commonly traded example of a financial instrument in stock markets. And it's the main ability for stocks is that it's able to multiply profits in a short duration. This is because most companies, at least in short periods of time, are able to improve their performance, whether it be through production changes or increased output. And so they have the ability to improve their stock prices in the short run. And on top of that, if you have a relatively stable stock that you've invested in, it becomes a very good long-term investment because you can rely for it to be stable even in times of crisis, or at least relatively stable when the market's not performing as well as you want it to. The second is a mutual fund. So a mutual fund is essentially a pool of money that's collected from multiple investors that's pooled into a fund, as the name suggests once again. And so the money gets allocated to different stocks, bonds, futures, and options. All of these are different financial instruments that we will cover. But what essentially happens is a percentage, let's say if you have 100 rupees, a percentage of that is pooled into stocks, into and other financial instruments, and the returns of that are returned to the initial investors of the fund. So the main aim of the mutual fund is to produce capital gains and give a set percentage return on investment. These are typically a stable way to get income because they invest in a very diverse amount of instruments. And so you can guarantee at least you'll get some returns. Although it may not be the best compared to other instruments, you are still guaranteed a percentage return or your capital back in some mutual fund schemes as well.
And the important point to note in mutual funds is that it is subject to market risks. So it is not the reliability of the money manager to actually make a return for you. It can also turn into a loss because it depends on the market performance, right? So the only disadvantage of mutual fund is you invest with a particular risk, and we'll look at risk and rewards in the future chapters wherein you'll understand why or why not to invest in mutual funds.
All right, so moving on to derivatives, this is actually probably one of the most complicated financial instruments. So we will prevent ourselves from going into too much detail. All you need to know for now is that it's essentially a financial contract between two parties that guarantees a trade agreement or a settlement for financial instruments such as futures and options. So the value of the contract is determined by the value of an underlying asset. So this could be anything like the share of a company or the current value of, let's say, the rupees versus the American dollar or current interest rates. And so the derivative just creates an agreement that at when the price of, let's say, bread was 100 rupees, that's when most companies will have to buy that piece of bread. And so that's the kind of thing that the derivative aims to do. And this is just an entry level understanding of what derivatives are, but it's not necessary to know a lot about this unless you essentially just exclusively trade in derivatives themselves. But this is what you should know for derivatives in the first place. Now, moving on to bonds. So bonds are actually just a simple loan that's taken by a company or sometimes even governments. But instead of going to a bank, which you would typically do for a loan, it actually goes to investors. And so what it does is issues a fixed financial instrument which the investors buy. This instrument is called the bond itself, and it allows the company to receive capital because what the investors are essentially doing is they're buying the company's bond, and in exchange, they're giving away money. So the company receives capital essentially. And so what the company can do is, in exchange for the capital received, it pays regular interest at regular intervals and returns the principal amount to the investor. Because what the company is doing is it's just asking for a loan in the form of financial investment. And since loans come with some sort of fixed interest, the company has to pay back that loan with said interest back to the investors. And so there's usually a set deadline agreed upon for bonds. So it could be for the span of 1 year or 10 years, during which the company has to ensure that it pays all of the bonds as well as the interest it accrues back to the investor. It's very similar in nature to a financial loan because, well, the company must has to repay its all of its loans by a set deadline. But the one main difference is that it's issued to investors and that's issued to the public through a stock exchange rather than a loan being given privately to the company directly by a bank.
Okay, so now to discuss a lot about the different instruments that exist in the stock market, we're here to talk about the regulators, which are a very important participant in the stock market. So here are a bit more details about the roles of regulators and the type of stock market regulators that exist in India. So stock market regulators are regulators that act as mediators and are established by governments or other organizations to oversee the functioning and fairness of security markets and the stock market participants that engage in financial activity. So their role is to make sure that transactions and different like transactions that happen between participants happen securely and safely, and there's no like injustices going on when that exchangement of the instruments is taking place. So in India, there are three main regulators that we have that are commonly used to mediate transactions and look over financial activity. So these include the Securities and Exchange Board of India, which is SEBI, the Reserve Bank of India, which is the RBI, and the National Stock Exchange, which is the NSE. The main Indian regulator is SEBI. However, because it oversees all security transactions that occur in the NSE and every other known Indian stock exchange.
Right, so the basic functions of regulators is that they set rules and regulations, they legally track companies' performances, and they also keep every company within the legal framework. So basically they're like the teachers in the school kind of. And so the basic objectives of the regulators is that to ensure fair business practices by stock exchanges, stockbrokers, and subbrokers, to protect small investors and companies, and making sure that there's no exploitation by large companies, and to impose strict restrictions in the market, and also contribute to the development of Indian markets as a whole.
So just for an example for the objectives of and the function of regulators, take for example, if a stock market crash is going to happen and you know that the company prices are going to fall down, so the regulators imply a lower and a lower circuit, which means that beyond a certain percentage of the stock market that was being traded, the stock cannot be traded below that, right? So that prevents the company from making a loss and entering into a crash. So regulators particularly invest into these types of patterns and try to make a consensus to the companies that okay, you have to function in a right way. And also not with regards to companies, that also sees investors, because there are certain practices that are not legal in India, so like insider trading or trading in like bulks of stock but like manipulating the prices, right? So when that is sensed, the regulators come into the picture and investigate such issues. Okay, so we are going to move on to the case study. And this case study is quite famous in India because there was a movie launch also. And this is called as the Harshad Mehta scam. This can also be called as a 1992 Indian stock market scam. And it was actually a market manipulation carried out by the man called Harshad Mehta. Um, he manipulated the stock market with other bankers and politicians on the BSE, which is the Bombay Stock Exchange. And this scam caused like a significant disruption in the stock market of India because it defrauded investors, like, and caused a loss of over like 10 million USD, right? So the techniques that were used by Harshad Mehta involved like corrupt officials raising the prices up of the stock, and then there was signing of fake checks, misusing of the market loopholes, and then there was a fabrication to drive the prices of the stock up to like 40 times of the original price. So the stock traders were making good returns, but as a result of the scam and the fraudulent practices, it it ended up with the Indian stock market being crashed, and this caused a huge loss and a debt to the market. So we'll look into the detail of the case study in the following video. So yeah. So yeah, let's do this video and I'll explain what the stock market crash looked like.
one thing that is common between Harshad Mehta, Ketan Parekh, Nirav Modi and Vijay Mallya. They all found loopholes in the Indian banking system and exploited that to create insane amount of wealth. Today, we will tell you the story of the man who started it all, Harshad Mehta. Adjusted for inflation today, Harshad Mehta laundered over 24,000 crore rupees in the stock market over a period of 3 years. His story is nothing short of a Bollywood movie and there is so much to learn from it. So, let's start from the beginning. Harshad Mehta was born in 1954 into a very poor family. He completed his schooling from Raipur, but he was a very average kind of a student who didn't show much promise. He was even suspended from the school once for indiscipline and misconduct. After completing his schooling, he came to Mumbai where he did his BCom from Lala Lajpat Rai College. After graduation, he struggled a while taking low-level jobs, selling garments and appliances, etc. At that time, he had no idea what he was going to do in life, but he just kept exploring. His luck turned around when he joined New India Assurance Company as a salesperson, from where he first got interested into the stock market. He realized that this was the game he was born to play. So, he quit his job and joined a stock market brokerage firm in 1981. He quickly learned the ins and outs of the stock market, made connections with influential brokers, and within 3 years, he himself became a broker with Bombay Stock Exchange. By 1990, he had risen to prominence in the Indian stock market. He also established his own firm called Grow More Research and Asset Management. But Mehta was not satisfied with his success. He had bigger ambitions. So, in this lust for money, he started exploiting various loopholes in our banking system. At that time, Reserve Bank had mandated all the banks to keep a certain minimum level of funds into government bonds. By the end of each week, every bank needed to have a certain amount of government bonds, else RBI would penalize them. Now, there were some strong banks and there were some weak banks. The strong banks had no trouble keeping the minimum balance of government bonds, whereas the weak banks always struggled to do so. Think of it like a homework given by a teacher. The good students always finished their homework on time, whereas the weak students had to pay something to copy the homework of the strong students. So similarly, the weak banks always had to borrow the government bonds from the strong banks, and in return, they paid some interest. But these bank transactions were not done directly between the strong and weak banks. They were done through brokers, and one of them was Harshad Mehta. So Harshad Mehta would approach the weak banks and tell them that he would give them the government bonds they needed. And for getting them those bonds, the weak banks would write him a check on his personal name. Now, Mehta would ask them for some time to make the necessary arrangement. Since Mehta was so influential, these banks didn't mind waiting for a few extra days. Next, Mehta would approach the strong banks who had those extra government bonds and promise them to give that extra interest in return. Here also, Mehta would ask for some extra time. Since Mehta was very influential and reputed, neither of the banks had any problems giving extra time to Mehta. At the end of the promised time, he was keeping his promise to both the banks. The weak banks got the government bonds they needed, and the strong banks were very happy with the money they made from the interest. So everybody was happy. So how was Mehta making money? Remember that Mehta would ask for the extra time from both the lending and the borrowing banks? Well, during that time, he had all this massive cash in his own personal account and he was funneling that money into the stock market. He would pick select shares of the companies and just kept buying those shares aggressively. Because of this massive liquidity injection, the share prices of these stocks would go up, and because of that, other investors would also start buying the stock in anticipation of more movement. This would raise the stock prices even higher. But wait a second, if the money was being pumped into the share market, how was Mehta returning the money back to the strong banks who lent those bonds? Here is where his genius comes in. He was not just dealing with these two banks, he was dealing with a whole lot of them, and he became very good at rotating the money from lenders to borrowers. And whenever the stocks he pumped ran up a lot, he would liquidate his positions from the stock market and take care of any deficits. So all in all, Mehta was rotating the money between the banks and the stock market, and he was getting very good at that. All this was working out very well, but Mehta got more greedy. He wanted more. So he conspired with the officials of two banks, Bank of Karad and Metropolitan Cooperative Bank, to issue fake bank receipts that were not backed by any government bonds. So they were nothing but pieces of paper. Once these fake bank receipts were issued, they were passed on to the banks, and banks in turn would give money to Mehta, obviously assuming that they were lending against government securities, when that was not the case. This money was used to drive the prices of the stock in the stock market, and when the time came to return the money, shares would be sold for a profit and the bank receipt was retired. The game went on as long as the stock prices kept going up and no one had a clue about Mehta's modus operandi. This extensive liquidity gave an adrenaline shot to the stock market in general and the market began to make major moves. In fact, BSE quadrupled its index in a span of just 1 year, and because of that, Mehta's own portfolio of stock holdings gained in the value close to 10 times to an estimated 2000 crore rupees. One of the stocks he pumped was ACC. He moved it from 200 rupees to 9000 rupees. Just goes to show how crazy valuations can get when liquidity is behind a stock. Here are some other stocks that he later pumped. All this money made Mehta a hero in the stock market. People started calling him the Amitabh Bachchan of the stock market. He lived a very luxurious lifestyle and was never shy to show off his wealth. He bought a 15,000-foot property in Mumbai which had a mini golf course and a swimming pool. He had a fleet of foreign cars which were not even affordable to the richest of the rich people at the time. But all this show off and blind greed got him into trouble. An investigative journalist named Sucheta Dalal got wind of Mehta's modus operandi and she published an expose in Times of India. This was the beginning of Harshad Mehta's end. All the senior officials in the banks got alerted immediately and the lending banks began to ask for money. Now remember that paying money back was never a problem for Harshad Mehta because he would just sell his shares in the stock market and fulfill his obligations. But this time it was different because as soon as the scandal broke, the market started crashing and the value of Mehta's shares dropped steeply. So he had no way of repaying those banks. It didn't take much time for CBI to step up and they charged him with 70 counts of fraud. By this time Mehta's game was over. He was under criminal custody in Thane prison where he later died of heart failure. Mehta also took down a lot of senior officials with him. Vijaya Bank's chairman committed suicide by jumping from the top of a building. And top treasury officials from SBI, National Housing Bank and UCO Bank chairman, they all lost their jobs. But most tragic of all, thousands of investors lost their hard-earned money and most of them were never able to recover their losses. Once the hero of the stock market actually turned out to be the greatest villain for those investors. Interestingly, two of the biggest Indian traders of our time, Rakesh Jhunjhunwala and Radhakishan Damani, made a lot of money by shorting the market at the time. They had the vision and understanding that the valuations of this market were clearly not sustainable. So by taking some very astute short trades, they made a lot of money. We have made separate videos for Rakesh Jhunjhunwala and Radhakishan Damani, so don't forget to check them out. Harshad Mehta's story and more recently the Nirav Modi scandal are humble reminders that our banking system and the stock market are extremely vulnerable to manipulation. It also teaches us that when the valuations of the companies start to get on the crazy side, smart investors should start getting cautious instead of getting greedy. So folks, this was the story of Harshad Mehta. I hope you found this story useful. Do let us know in the comment section below and don't forget to subscribe.
Right. So after seeing this video, you might have got some questions as to the first one is whether Harshad Mehta was ethically wrong or right in taking such advantage of the loophole in the Indian banking system. And these questions need to be reflected upon. So I would like to ask that what was the role of RBI? And then how should the government market be regulated to avoid such acts of corruption? And what are the other examples of such scams committed in India? So while reflecting on these questions, you'll understand and will implement the learnings of this chapter, wherein you understand that the regulators are a most important player in the stock market to facilitate fair trade, and people that are influential are not always right. So you should go on your fundamentals and understanding about how you should invest in the stock market, and for that you need a very deep understanding of how the stock market functions. So with that, we bring an end to chapter number 3. So thank you so much.